Ever felt like a complete novice in the stock market world? If you haven't, I have. Terminologies used to describe certain actions that occur in the stock market can be hard to understand. But do not worry. In today's video, I'll explain every stock market concept in 9 minutes. So sit back and relax as we delve in. Stock. A stock is a small fragment of ownership of any company available to people. Shareholder. A shareholder is someone who possesses a small fragment of ownership of a company. Shareholders are also called stockholders. Stock exchange. The stock exchange is a huge marketplace where securities are bought or sold. These securities may include stocks, bonds, or derivatives. It is a financial platform that unites investors from all spheres. Public company. A public company is a company that issues ownership to investors by allowing them to buy shares of its stock from a stock exchange. Bull market, bear market. A bear market is when stock prices are on a decline, typically by at least 20% from the previous high. A bull market is when stock prices are at an increase. Volatility. This refers to how prices fluctuate in the stock market. Volume. Volume refers to the total number of traded shares of security within a given time frame. Capital. Capital is simply the resource used to make money through investments in the stock market. Liquidity. Liquidity is how quickly an asset or security can be bought or sold in the stock market. Bubble. A bubble is described as significant inflation in the prices of assets like stocks, commodities, or even real estate. IPO. IPO stands for Initial Public Offering. This is when a private company offers its shares to the public for the first time. The essence of doing this is to raise capital from investors by allowing them to have ownership stakes in the company. Dividends. These are fragments of a company's profit that are distributed to their stakeholders. Blue chip stocks. These are shares of companies with a track record of stable earnings and success. Forex. Forex simply means foreign exchange. Forex is a decentralized global market for trading currencies. Portfolio. This is a collection of investments or financial assets like bonds, cash, and exchange-traded funds, ETF, owned by an individual, an entity, or an organization. Holdings. Holdings refer to specific assets or investments that are found within a portfolio. Interest. Interest can be described as the charge you get for borrowing money. Bonds. This is a type of investment that represents a loan you make to a borrower. The borrowers are typically big corporations or the government. Security. These are financial assets, investments, or instruments that can be traded. They represent company stakes or asset ownership. Broker. Brokers are middlemen who facilitate the trading of financial assets, acting as bridges between buyers and sellers. Going long. Going long refers to a situation in which an investor buys a financial asset with the expectation that its price will increase in the future. Asset. An asset is any resource of economic value and importance owned by or controlled by an individual, a company, or a corporation. Commodity. A commodity is a good or resource traded and used in producing other goods and services. It is usually of high standards and consistent quality. Commodities could be energy or even metals. Yield. Yield is simply the profit or income earned by an investment over some time. P/E ratio. This stands for price-to-earning ratio. It is a metric used for valuing stocks. It compares a company's current share price to its earnings per share. It is calculated by dividing its market price by its earnings per share. Index. This is a statistical measure that tracks the performance of a specific aspect of the stock market. Futures. These are financial contracts that obligate investors or traders to buy or sell a particular asset at a predetermined price on a future date. Options. These are contracts that give a trader the right to sell or buy underlying assets at a given price within a specified period. ETFs are exchange-traded funds, a type of investment fund traded on the stock exchange market like stocks. ETFs gather assets from various investors to invest in a multiple-streamed portfolio of stocks. IRAs, known as individual retirement accounts. As the name suggests, these are accounts created to help save money and invest for retirement using a tax-advantaged method. Liability. Liability simply means a debt that either someone or a company owes. Liabilities could be in the form of accrued debts, taxes payable, accounts payable, legal responsibilities, and many others. Penny stocks. These are shares of small companies that buy or sell for very low prices per share. Market capitalization refers to the overall market value of outstanding shares traded by a publicly recognized company. It is calculated by multiplying the share price per share by the number of outstanding shares. Leverage. This requires the use of borrowed money or assets to increase the potential return on an investment. Balance sheet. A set of records that shows a company's financial position at a given period. It shows the company's assets, liabilities, and shareholder equity. Inflation. Inflation refers to the overall increase in the price of goods and services in an economy over some time. Bid. A continual offer made in an attempt to purchase a security or an asset. Ask. This refers to the lowest price a seller is willing to take for a security or an asset at a particular time. Bid-ask spread. This is the difference between the bid price and the ask price. Black swan. Black swans refer to unpredictable events that could greatly impact the market, causing distorted volatility and many other issues. Black swans can have a widespread impact and can cause financial losses. Dead cat bounce. This term describes a temporary rise in the price of any asset or security following a significant decline. Whales. Whales are used to describe big investors who hold significant amounts of assets and are capable of influencing the market via their significant holdings. Unicorns. Unicorns are privately owned startup companies with a valuation of over $1 billion. Some unicorns include SpaceX and Airbnb. To the moon. In stocks, cryptocurrency, or other investments, the term "to the moon" describes a strong enthusiasm about the price or value of an asset hitting a sustained and significant increase. Tanking refers to a rapid decrease in the price or value of a financial asset, which results in losses for investors. Jigged out. This is another term used to describe a situation when a trader exits a position after an initial profit has been made. Pump and dump. Pump and dump are illegal actions carried out within the cryptocurrency space and other investments, which involve using misleading and untrue statements to artificially inflate the price of an asset or security, causing a pump. When this occurs, the assets are sold at inflated prices to other investors, causing a dump. Rug pull. This statement refers to a corrupt practice where developers of cryptocurrency projects abruptly leave or abandon a project, taking with them the money of people who invested in that project. Panic selling is a situation in which investors sell their assets or stocks in large volumes due to fear or uncertainty, causing a decline in the price and value of assets. Shorting is a strategy that allows investors to profit from an asset or stock that is already declining in price and value. Short squeeze. This situation happens when the price of a stock that has been significantly shorted rises quickly, causing investors to buy back shares to recover their short positions. The purchasing pressure from short sellers trying to regain their positions can increase the price of a particular asset. Limit order. A limit order is an order given to a broker to buy or sell a given financial asset at a specific price or better. Stop-loss order. This is one of the most popular terms in stock, cryptocurrency, or forex market. It is a risk management tool that stops trades leading to significant losses. Long squeeze. This is the exact opposite of the short squeeze. With the definition of the short squeeze given earlier, can you tell what the long squeeze is? I'm sure you can. A long squeeze is an abrupt fall in the price of an asset that has been experiencing a prolonged upward movement. Market order. This is an order given to a broker to buy or sell an asset or security at the current market price. Good till canceled order. GTC is an order given to a broker to sell or buy a security at a price that remains active until the order is filled or canceled. Day order. This is an order given to a broker to buy or sell a financial asset that expires at the end of the trading day. Averaging down is an investment strategy that involves purchasing additional shares of stock at a lower price than your initial buying price to reduce your overall average cost per share. Fading. This is a strategy that involves taking a position that is contrary to the prevailing market trend based on an analysis that suggests trend reversal. Hedge fund. This is an investment fund that arises from a pooling system that employs difficult trading techniques and strategies to generate high returns for investors while using other financial tools. Mutual fund. A mutual fund is a professional vehicle that pools money from several investors to facilitate diversified investments in a stock portfolio. Control stock. Some investors own a lot of stocks in a company. They own enough stock to determine how the company runs. These shares owned by these investors are what we term control stock. Holding company. A holding company is a big company that owns major interests in other smaller companies commonly referred to as subsidiaries. Index fund. An index fund is a type of mutual fund or ETF designed to replicate the overall performance of a specific market index. Day trading. Day trading is a unique strategy that involves trading stocks, financial assets, and securities within the same trading day. Swing trading. Swing trading is a unique trading strategy that occupies the middle lot between short-term trades and long-term trades. Intrinsic value. This refers to the calculated underlying value of an asset, which could either be bonds, stocks, or options. Book value. Book value refers to the total value and worth of a company's assets as it is recorded on the balance sheet. Price-to-book ratio. This is simply a financial metric used to compare a company's market value and book value, which also indicates its net asset worth as recorded on a balance sheet. Value investing. Value investing involves the identification of stocks or securities that trade at discounts to their intrinsic value with optimism for an increase in value in the future. Earnings per share. This is an important metric used to determine how profitable a company has been in terms of its outstanding shares. EPS is calculated as net income, preferred dividends. Growth investing is a strategy for picking out companies with the potential to grow their earnings above the average mark. Technical analysis. This is a trading strategy that involves predicting the direction of price movements by studying historical market data, volume, and price. Fundamental analysis. Fundamental analysis hinges on the intrinsic worth of investment by analyzing the health status of a company, its prospects, and its overall economic condition. Efficient market hypothesis. This is a financial theory based on the ideology that all information is responsible for the overall outcome of market prices. Supply and demand. Supply and demand is an economic principle that explains how the price of goods and services are determined. It is a concept used to explain the equilibrium between sellers who are willing to produce something and buyers who are willing to pay for what is produced. Insider trading is the illegal act of trading company securities like bonds, stocks, and options while possessing non-public information about the company. Ticker symbol. A ticker symbol, also called a stock symbol, is a unique trading symbol that identifies publicly traded companies on stock exchanges or financial markets. Compound interest is the process of earning interest on both the principal amount of an investment and any other accumulated interest. Profit margin. This is a financial ratio that measures the profitability of a business or venture. Dollar cost averaging, DCA. This is a financial strategy that reduces the impact of market volatility on the overall investment cost. Return on investment, otherwise known as ROI, is a metric used to measure the profitability and efficiency of a particular investment. Market order imbalance. This refers to the situation in the stock exchange where there are noticeable inequalities between buy orders and sell orders for a particular security. Initial margin. This is the amount of money required by a broker for an investor to deposit when using a margin to buy securities. Maintenance margin. This is the minimum amount of money that must be maintained in a margin account to continue holding leveraged positions. Margin call. The margin call is a situation where a broker contacts an investor to deposit more money to enable the margin account to reach the required level margin account. This is a type of account that allows investors to borrow money from brokers to buy securities. Stop order. This is an order given by an investor to a broker to buy or sell a security when it reaches a specific price. Trailing stop order. A trading stop order is a type of order that is set at a certain percentage or a dollar amount that sits below the market price for a long position. Market on close. This is a type of order set by an investor to close prices at the end of the trading day. Thanks for staying with me till the end. If you love this video, then you should check out the next video on your screen. See you in the next video.